Good morning, it's Jeff Christian, CPM Group. Friday, the 9th of July, about 10:50 in the morning. I'm going to talk mostly about platinum, I hope today, platinum group metals today. I call them the other precious metals, as you can see from the title here. They're metals that we've studied since the 1970s. We published what's considered the first platinum group metals market report in 1981. It's here on the left-hand side of this cover. It was May of 1981. I remember when I had just started at J. Aron in 1980. They produced gold and silver yearbooks and statistical reviews and outlooks for about a decade before they hired me. And after I'd gone through the gold and silver cycle, I suggested a platinum group metals report, and I remember they said, is there enough to say about these metals? And at the time, these were extremely secretive metals. The platinum producers in South Africa did not even publish data in their annual reports or anyplace else as to how much platinum or palladium they were producing. And we produced this 120-page report, which people still ask about today because it had information that has never really been replicated on the history of PGMs prior to 1980. And I remember, the chairman of Rustenburg Platinum, which was the predecessor for Anglo Platinum, called the chairman of J. Aron and suggested they fire me for revealing so much information about platinum group metals. And I've often joked that the highest honor a totalitarian regime can bestow upon an analyst is to examine or investigate his sources. And after we came out with this report, the Soviet government, Rustenburg Platinum and Impala Platinum all launched internal investigations to see who had slipped us information. And that was the only confirmation we got that our data was halfway accurate, because it was all estimated from the outside, the extremely secretive market. And yeah, if our numbers were way off, they wouldn't have tried to figure out who it was in each organization that was either slipping us information or confirming our data. In reality, it was just good research, a lot of fundamental research. And we've produced annual PGM reports ever since 1981. We produced the Precious Metals Advisory, which came out last night for July. And then we produced annual Platinum Group Metals Yearbooks, which comes out next Tuesday. And we produce long-term reports, such as you can see the cover here from 1998, with 10-year projections of supply, demand, and prices for platinum, palladium, and rhodium. And we've produced those 10-year projections since the 1980s, as we have the annual yearbooks and monthly and other reports on PGMs. So I wanted to talk a little bit about PGMs this week because, again, as I said, we have the Platinum Group Yearbook, Metals Yearbook coming out next Tuesday. There is a webinar. There will be a link where you can register to attend the webinar on the cover note to this video. And there also should be a link as to where you can buy the report for $160 in the email, the cover email for this video. So that report will come out next year. And I'll talk a little bit about PGMs, but before I do that, let me just do some quick gold and silver updates. Last week's video, we talked about the potential for increased volatility in gold and silver prices over the course of July. And we certainly have seen increased volatility in gold prices over the first week of July. The price had been in the $770, $1,800 range. It broke above $1,800, went up to about $1,819. It came back down, fell below $1,800 yesterday, and it's trading $2 or $3 on either side of $1,800 today. Silver has been less volatile, and that's a very worrisome factor. I mean, there hasn't really been a lot of activity there. So I'll get to that in a second. We have seen London gold and silver inventories for June released, and silver inventories in London are at a new record level. We have gone into the July COMEX delivery period. As of yesterday, the amount of deliveries, the issue of delivery notices and the taking of delivery notices has been relatively small compared to where it was, say, in December of last year, much less March and May of this year. So it's not like there is a draining of inventories. And of course, most of the inventories that have been taken, depository receipts that have been taken delivery of, have been taken delivery of by JP Morgan and other major banks that are bullion banking groups. And that represents really metal that they're taking off through the exchange, mostly for industrial fabricators. So the inventories, there hasn't been a rush to drain the inventories on COMEX. And most of the inventories actually have stayed in the depositories and have stayed registered with the COMEX. So that whole big squeeze thing kind of hasn't really happened. And that leads to discussion about the lack of volatility in silver prices and the risks that both gold and silver have that you are seeing already. Stale bull liquidation. People who were buying gold and silver earlier in the year and late last year because they thought the prices would rise, and they did rise a little bit early in the year, but they haven't continued to rise. And in fact, they've been kind of stagnant. And you have a lot of stale bulls who are saying, I'm going to take my profits. You're seeing that in the futures and options markets. You're also seeing it in the ETFs. ETF inventories of gold are off this year. And really over the last few months, you've seen a decline in gold and silver ETF holdings, about 340,000 ounces, I think, last month in gold ETFs alone. And I think several million ounces in the silver ETFs. So you've got some farmer bulls who have pulled back from it. In addition to that, you had seen earlier in the year a lot of novice investors into precious metals, people who were new to precious metals, and they came in because they were hearing all that fear mongering about, the global financial system is going to collapse, the dollar is going to collapse, the treasury is going to collapse, T-bills are going to skyrocket, there's going to be hyperinflation. Oh, the Basel III rules, that whole hoax that the Basel III issues would destroy bullion banking, that came and went. No one blinked an eye in the actual market. Now I think people are scrounging around trying to explain why that didn't happen. The squeeze that wasn't a squeeze, and then you had the guys who had promoted the squeeze saying, well, when we said squeeze, we didn't mean that we drive the silver price to $100. Please please ignore all of that stuff where we were saying the price of silver is going to be $100 by May or June or July, because it really has had a tough time breaking over $28, $30. So there's a lot of these novice PMs, investors, who have come into the market based on a lot of this fear mongering and other commentary, and now they're disillusioned. And that's bad for precious metals in the long run, because if you missell something once to someone, they're going to remember it. And other people who sell stocks and bonds to them are going to say, yeah, that was a great experience you had in gold and silver in early 2021, right? You really should stay in stocks and bonds. So I think that that's kind of going on. I'll also talk a little bit at the end of the year, at the end of this presentation, about the yearbook, the retail investment program, and the coming open forums. So this is just sort of a brief overview visually of the extended period of time that we've been writing about precious platinum group metals. Here, I've just gone through what I was talking about here. The precious metals, the platinum group markets, the precious metals, gold and silver, have a lot of bad data and bad analysis in them. And the platinum group metals have even more. And they don't have 6,000 years of history as money and quasi-money, and they don't have as broad of a spectrum. The upper left-hand corner here, and this is from 2018. I didn't bother to update it. I'll show you an update of one of them in a second. And you can see, CPM Group has had surpluses in the platinum market 2014 was a big strike, but 2013 through 2018 in this chart and continuing last year and this year. And that is because, as I've said in previous videos, we do precious metals research. And in commodities research 101, basic commodity economics, a surplus and a deficit is total new supply less fabrication or consumption, in the case of oil and agriculturals, demand. You do not include investment demand in there for a variety of reasons. First off, you want to see if the market is fundamentally and primarily in deficit, or consumers and fabricators using or consuming more of that commodity than is being produced, and is the market living off of inventories? That's a much more bullish market outlook than if investors are buying the commodity and pushing the price higher. So commodities 101, and you see this across all commodities, is total supply less fabrication demand equals a surplus or a deficit. And that's what we do, because we do real research. And you can see we've had surpluses in platinum, and those surpluses fit in very nicely with the profoundly weak platinum prices that we've seen since 2015. Platinum prices fell sharply after the strike in 2014, and they have yet to recover. Last year, they started breaking above $1,000, having fallen from $2,000 in 2008. Other people produce precious metals, and they also produce precious metals research or market reports. They compete with us. And one of the things they do is they dump investment demand into their data, and that way they can show deficits. But if you adjust their data for taking out the investment demand, those deficits either shrink sharply or disappear and become surpluses. And you can see that with these groups. And most of these groups are primarily selling precious metals or trying to provide marketing support to people who sell precious metals. So this was some data we did for a major producer's largest owner back in 2018. This is an update of that a little bit for the World Platinum Investment Council's data. And the chart is from the first quarter of 2020 when somebody asked us to update that. And you can see these massive surpluses that appear when you take out the investment demand. So in 2019, they said, oh, well, there was a deficit. But if you take out their surrogate for investment demand, all of a sudden there's more than 1 million ounce surplus, they said surplus. And if you take, they had in early 2020 said, oh, there might be a surplus this year. But again, if you adjust it to take out the investment demand, it's a much smaller surplus. So the table on the right is the data from their first quarter 2021 number. And you can see they had estimated that 1.5 million ounces of platinum were bought by investors last year. And that gave them a 932,000 ounce deficit. If you adjust it and take out that 1.5 million ounces, there is a 617,000 ounce surplus. And again, those surpluses that you get by adjusting their data make sense when you look at the weak platinum prices over that period of time. I'll get back to that in a second. But you really need to look at the market as a market of a commodity with total supply less fabrication demand. And investment demand is an off-balance item. It's a change in stock ownership as opposed to actual demand in which the platinum changes its nature and is not readily resaleable into the market. Now, as pointed out, platinum prices $1,400, $1,700, $1,800 in the post-global financial crisis and Great Recession period from 2010 to 2013. In 2012, some of the institutional investors and high net worth individuals who had bought a tremendous amount of platinum in the period 2000, 2001 through 2007 into early 2008 started selling their metal. And you saw the price weaken in 2012. You saw the price weaken further in 2013. And when the strike occurred in 2014 and the price flatlined, you had South African production offline for almost half a year, or roughly half a year, and the price did not rise sharply. When that happened, those investors who had platinum inventories, and there were a lot of platinum inventories, said, what happens when that strike settles? It's going to get nasty. And it did. The price went from $1,500 an ounce to about $800 an ounce over the next 18 months. It traded by and large below $1,000 for most of the period from late 2000, the second half of 2015 into the beginning of 2021. It has now broken above that level. I'm glad to say that we had been projecting that, and it has come to pass. And we think that over the next several years, the platinum price could rise higher, more sharply and more significantly. All of that is discussed in the Precious Metals Advisory to a short extent for short-term views, and in next week's Platinum Group Metals Yearbook, which comes out on Tuesday, and discusses the supply-demand dynamics, investment demand, inventory levels, and some of our price expectations. We don't give away our 10-year projections in the Gold Platinum Yearbook, but we do talk about where we think the market's going this year, the rest of this year, and we do talk about where we think it's going in a longer term to some extent. So platinum prices have begun to break out of their range that they've been in, and it's been a low range. Palladium's the exact opposite. You saw palladium, which was really kind of moving sideways for most of the period from 2011 to 2018, started to rise really in 2016 from the bottom of that range, broke above that range in late 2017, and then has skyrocketed to record levels. And frankly, if you look at our expectations for the next 2-3 months, we would not be surprised to see the palladium price trade between say $2,500 on the low end and possibly go back up and test $3,000 again. The palladium market is much tighter. There are dynamics that are shifting between platinum and palladium because of the price differential. It's all explained in the yearbook. But it's actually probably going to stay high simply because the market is pretty tight. And then rhodium, the third metal. We had been saying for several years that we thought the rhodium price could go parabolic, as it has several times in the past. This only goes back to 1992. You can see the price is falling. We had a parabolic increase in 1980-81, again in 1989-90, and then again in 99, and then again in 2005 through 2000. Into 2008. Each time it came back down. And our view is that the rhodium market is much tighter now with far fewer above ground refined inventories than existed in the past. It's all explained in the yearbook. And we had been saying that we thought the price could go parabolically higher and possibly stay at extremely high levels simply because there's not a lot of metal in inventories that's going to meet that future demand. There are people who are saying, well, you could have deficits ongoing, as you have had for most of the last 40 years in rhodium. You could have these deficits continuing, and they could total 500,000 ounces over the next 5 years. And CPM Group's view, having written about rhodium since 1979, is that there's probably now 500,000 ounces of above ground inventories to meet that kind of deficit. So the imbalance in the supply versus fabrication demand probably has to be met through the price. No, not probably. Price has to be the mechanism by which supply and demand come into balance. These are our intermediate term recommendations, starting in December 1980, when I started keeping track record of our where do we think the price is going to go 2 or 3 years from now? Would we be if we were an investor, would be a buyer with a 3-year time horizon, or would we be a seller? And we started keeping track of that when we were at J. Aron before it merged into Goldman Sachs in 1980. And you can see the first week of December when we said, let's start keeping track of this, the first thing we said is sell platinum. And we waited until the middle of 1982 to issue a buy recommendation. And we did that through one of those J. Aron reports that I showed you the cover of, the first one earlier. And you can see back and forth, buy and sell, long period through the 80s and into the late second half of the 90s, where we had said, just stay away from platinum. Then starting around 97, we started saying, hey, this looks interesting. 2000, 2001, 2002, we said, no, it's much more bullish market. And we continued to do that into late 2009, 2008 or so. And you can see the price rose. The price rose because investors were buying. And I'm glad to say and proud to say that a lot of those investors were CPM Group clients. They were buying our research. We had told them to not invest in platinum through the late 80s, early 90s. We had issued a sell recommendation when the price got to our objective in November of 1986, I believe. And we had kept them away from platinum for a decade, and they had not lost money being long platinum. So when we said buy platinum and expect the price to rise sharply, they did. And their buying basically drove the price higher. And that lasted into 2008. Got very volatile for a period of time. I won't bore you with the details. What I will bore you with is the results of that kind of research. That accurate fundamental analysis yields a better return for investors. And you can see here, if an investor, on the day that we started keeping records of ourselves, December 1980, if an investor said, Jeff, you got funny hair. I'm not going to take your advice. I'm just going to buy platinum and hold it. That investor would have made about 94% profit from 1980 until the present. That's less than 1% per annum as a compounded annual rate of return. If the investor had taken our advice, sold metal that day, thrown the profits of that metal into T-bills, and then when we said buy, close out the T-bills, buy platinum, and gone back and forth trading platinum and palladium, just not on our short-term trading recommendations, but on our intermediate term trading recommendations. If that investor had done that, he'd have a 15% annualized return, which is almost enough to rival the return over the same period of time of Berkshire Hathaway. And compounding it, it's like something like a 278% return, or not compounding it, just in terms of the overall returns on it. And this is a way of visualizing that. Now, we offer short-term, intermediate-term, and long-term strategies. And some of our investors actually can follow that logic there. So we are saying to them right now, from a long-term perspective, platinum looks good for the next 5 to 10 years. We think the price of platinum is going to rise and rise significantly at some point in that longer-term time horizon. From an intermediate-term view, you can see, if we can get back there, we have issued a buy recommendation around late 2019, early 2020. So we're telling people from a 2 to 3 year time horizon, hey, you should be long platinum if you're interested in being in platinum. And so far, that's made sense because we were telling them to buy when the price was below $1,000 and the price is now over $1,000. And then from a short-term perspective, I'm not quite sure what we would be saying right now. Probably we're looking for the price of platinum to trade sideways to slightly higher over the next 3 months. And over the next year, we think that the price of platinum will resume its increase because it's moving toward that period of time. We produce real research. You will never hear us say, as some people said in 2015, the price of silver is going to $1,500. because real research doesn't support that view. And as I've said before, the guys who say stuff like that, they don't get gold and silver wrong. They get the global economy and political environment wrong. Yeah, I'm predicting the collapse of the dollar. So gold is going to $1,300 and platinum and silver is going to $1,500. $13,000 gold, $1,500 silver. And it's not that they're wrong on gold and silver. They're wrong on their doomsday economic view. And then they double down and say, oh, no, not $1,500, $13,000, because the dollar is going to collapse. And then last week, they start saying, well, you know what? We always advise people to buy and sell metal and try to take advantage of these short-term moves. That's what we do personally. And then they kind of get like nasty about us because we've been right and they've been wrong. Anyway, the Platinum Yearbook comes out next Tuesday. There's a webinar. It's free. You should be able to register from the email that covers this video. We welcome you to be there. We think that if you're interested in PGM markets, this thing is worth $160. You can also buy our gold and silver yearbooks. We continue to work with the retail investor program that we put together earlier this year. As investors were saying, I'm hearing all this nonsense about there's not enough silver in the world, and oh, green technologies are going to use hundreds of millions of ounces of silver, and there's not enough silver there, and reserves are down because the world's running out of silver. And I really need good advice. So we put together a retail investor program, and we've gotten pretty good responses of investors saying, yeah, I really need to plug into real research. This nonsense I'm getting for free just doesn't add up. And quite frankly, I'm losing money. And you can see here in June 4th, a guy who has become a subscriber to our retail investment program has said, this program saved me a tremendous amount of money. It's already paid for itself. And when he says paid for itself, the price is at the bottom. It's $2,500 a year. Yeah, thank you. So you get quarterly open forum invitations. You get the yearbooks, gold, silver, and platinum. You get one copy of our monthly precious metals advisory to give you a flavor of it. But we do give you every month the last page of it, which is our price projections for the next 8 quarters on a rolling basis. You get market commentaries when we publish them. And frankly, we haven't been publishing as many market commentaries because we've been publishing more videos, but we do publish them. You get access to videos. If we do special videos, you'll get access to those. We're planning to, we haven't done it. We've been doing videos for close to a year now, and we're understanding that people don't want to read a 200 or 400 or 600 page report. They want to hear a 20-minute video. And then you have our trade recommendations on gold and silver, and market alerts, which we produce when something really dramatic happens, or there's an announcement that we want to say to all of our paying clients, hey, watch out, this has happened and this is what it means. So that's the retail investment program. And as the man says, pays for itself in a matter of months if you use it wisely. It's like a gun. You can shoot yourself in the foot, or you can use it to feed yourself and your family. We do have these open forums that we have for our clients, both our institutional and large commercial and government clients are able to plug in. They can send questions in ahead of time. They can send in questions or call or speak questions during the thing. We make it available to our retail investors clients. So we have the first one that we had, I guess, in June. The third quarter one we will have on August 25th, and the fourth quarter one is scheduled for the 17th of November. And again, if you're a CPM Group retail investor client, you can have access to that. That's all I have for now. Have a good weekend. Stay safe, stay clean, be good to yourself, be good to other people, and we'll talk to you next week.